I've been talked in my previous term as chairman of team. I had the privilege of going to Denmark and to NATO EU, and the thing that always struck me was the number of young people, mass young people behind NATO EU, and we're missing that in Britain at the moment. It's a thing we have to resolve. Now I'm going to ask Antonis Ragoussis. I hope that's
excellent.
Oh, right. we put the speaker representing Greece for last because it is the symbol of how the crisis in the EU and the Eurozone has brought a country to its knees and made it subjugate to Brussels and to Germany. So I ask you to speak to that.
All right. First of all, thank you for your invitation for this conference. It's indeed a pleasure, and it's in fact very encouraging to have discussions like that with like-minded people throughout Europe, because especially in Greece, the situation with the anti-EU movement is very, I wouldn't say peculiar, because I realize that the problem is throughout Europe the same, because indeed although in the analysis of the problem, both right-wing and left-wing analysts and the political movements agree, they tend to disagree on the solutions, and they end up in a state of dividing the people themselves. So this is where EPAM was created. We were created through the movement of the squares during 2011, with millions of people in Greece who were protesting against austerity measures. So EPAM stands for United People's Front, and our main ideology is that at this point it doesn't matter whether a person is left-wing or right-wing, as soon as we do agree on 5 basic principles, and all of them are based on the fundamental idea of national sovereignty and the fundamental idea of restoring democracy in our country. So I know most of you are already exhausted, so my a little bit technical analysis hopefully won't be the knockout punch. But in fact, myself, I joined the EPAM because it wasn't just about the principles, it was about the practical solution to it as well. Coming from an economics background, I couldn't find a political organization which had a very specific economic program and a very specific economic analysis behind what was happening, not just in Greece, which is a peculiar case, but overall in Europe. So there were a couple of questions before, which were very interesting, and I think at the core of the problem, which were related to debt, which were related to deficits. And I wanted to concentrate on the euro as a currency, because I think that the European Union overall is the problem, and especially the policies of the abolition of any kind of protectionism of economies, which led most of the less competitive economies into a state of being totally dependent on imports, and even destroying the limited production capabilities that they already had. But the euro as a currency was an accelerator which amplified all these disastrous effects of joining the European Union. And that's the reason why I wanted to concentrate a little bit on that. Although most of you are British citizens and you don't exactly relate to how the euro as a currency has destroyed the rest of Europe. But again, in my opinion, it's very, very important and essential to understand the dynamics behind it. So starting from it, economic theory, in terms of monetary theory, has 3 basic principles. That when you're using a currency, there is a holy triangle, if you might, a trinity. And from that trinity, you can either have 2 of its components, you cannot have all 3 of them. So the 3 components are, number 1, a relatively fixed exchange rate. Second part is fully integrated financial markets and liquidity in the markets. And the third one is monetary policy. Why am I saying all that nonsense? The reason why I'm stating that is to make a very fine point that the introduction of the euro as a currency is not at all incidental, and that it's not that the eurozone it's not working properly. It does work properly. This is how it's designed to work, and this is, in my opinion, is very important to address this issue. Starting from that point, I think that it's very interesting to consider that the main economist behind the conception of the euro was an American economist. And in fact, it was Robert Mundell, an economist from Columbia University. So, or otherwise, the main economist behind Reaganomics. The main conception behind it had to do with a very fundamental problem of financial markets, and that was instability. Because the main reserve currency throughout the world was the United States dollar. And due to the fact that the market forces weren't controllable in a state as which the exchange rate would be relatively stable, there had to be an artificial counterpart to it. As soon as it couldn't be gold, because it failed, and the Americans themselves abolished it, it had to be something else. And that something else was the euro. It was another reserve currency, another strong, hard currency, which would be used in financial markets as a stabilizing factor towards the dollar. Because this is another misconception. A lot of people think that there's a war between the euro and the dollar and so on. But there's nothing like that. The Americans want the dollar, want the euro to be successful. They don't want it to collapse. And in fact, in terms of the dynamics of the currency itself, what happened with the euro is, in terms of the Trinity, to go back to the Trinity, we did have a relatively stable exchange rate, which is the first principle, and we wanted integrated markets because all the markets had to be one common market, as it was mentioned before. Therefore, we couldn't have monetary policy on sovereign level. What does that mean? The second part of the argument has to do with how the currency itself functions within the economy. Does it function as a part of the economy, or does it function as an outsider of the economy? And now comes the part of the foreign exchange markets. Okay, hopefully not too confusing up until that point. The foreign exchange markets are a market of 5.3 trillion a day. Just keep that number in mind, right? This is the GDP of Germany and Italy throughout a year. Okay. As soon as we've got this in mind, then we have to take into consideration which are the enormous forces behind a currency which plays a major role in this market. Because it wasn't as the drachma, as we had in Greece, right? Or the leva that they have in Bulgaria, or all the other currencies, which play a very small role in the foreign exchange markets. It was the euro, which was the counterpart of the dollar. So these extreme forces on the foreign exchange market are the main driving force behind the currency itself. It's not the economies of the euro. It's not the economies using the euro as a means of transaction, of their internal and external transactions. It's the currency on its own, separately. So if you think about it, you have a hard currency with a very specific exchange rate, which has to reflect 19 different economies, very diverse economies, both in terms of their fundamental capabilities and in terms of their fundamental problems. So instead of using the currency as an instrument in order to facilitate whatever needs, in order to explore any potentialities of the country or deal with any problems, you have to adapt the economy to the exchange rate. Okay, hopefully clear up until that point, this point. All right. Next, what is the next stage though? Because the exchange rate itself, it's not incidental. The reason why there had to be a strong exchange rate relative to the dollar was that the American exports had to have an advantage, which they do have up until today, although the euro collapsed. But at the same time, that exchange rate couldn't be supported by most of the European economies, with the exception of the northern economies, namely Germany, the Netherlands, and even financialized economies like Luxembourg and so on. But the rest of Europe, from an economic perspective, couldn't support the exchange rate. So as I said before, as soon as you cannot use the currency as an instrument, you have to adapt the economy to the exchange rate. So there are two ways to do it. As it was said before from one of the speakers, one of the ways to deal with debt and deficits and so on is printing money and devaluating currencies. You cannot do that in the euro, of course. So the only way that you can meet the gap between the exchange rate and the potentialities of the economy, the capabilities of one economy, is through debt, which is the first way to do it, facilitate it. And the second way to do it is through internal devaluation. You cannot devalue the currency, so you devaluate the whole economy. All right, hopefully clear. Again, why am I saying, or why am I making this point? I'm making this point because up until 2009, the fact that the whole market was integrated and very liquid, every single member state of the Eurozone was considered as the same, because the credit was not based on the country and the specifics and specific problems, capabilities of each and every economy, but according to the currency itself, which was a currency on its own as a mechanism. And that's the reason why Greece could borrow with pretty much the same rate as Germany, or Italy the same, and so on. So as soon as the debt system was working, everything was perfect. And that's the reason why there were no problems, apparent problems in Greece from 2002 until 2009. Everything was perfect because debt was easily accessible. But why would one want to produce such a problem which was that short term? Because within 7-8 years there was a bubble. The reason is the whole financialization of the economy. Because it's not anymore about huge corporations which deal with production as production its own. It's more about the war between the financial institutions and the real economy. And of course, there is a part where both of them combine, where you've got investors with more diversified portfolios which own both banks and they're both involved in the industry. But at this point, we've actually reached a point where the economies which already have competitive disadvantages towards other European countries, these disadvantages deteriorated within the European Union anyway. We've got the example of Greece. We had deficits, trade deficits, which were near 2%, and now we've ended up in a position of having enormous trade deficits, which have tripled within the European Union, and now they're quadrupled within the Eurozone. So these economies, which were not in a position to produce, they ended up in a position of becoming providers of cheap services, because all these parts of these economies which were related to production, they couldn't compete with German companies or Dutch companies or even Italian companies at some point. But now even the Italians have problems with competing with Germans. So these companies were not in a position to sustain themselves. And that's the reason why Greece is an exceptional example of a country which was financialized from literally zero. We've never had a financial history in Greece as being a financial center. And an indicative statistic of such is that in 1993, out of $1 of foreign direct investment, 60% of that, 60 cents of that, were directed to the real economy. In fact, 59%. 31% was directed to real estate investments, and 10% was directed to the financial sector, whether that would be bonds, derivatives, anything related to the financial sector. In 2009, which was the year of chaos, the Armageddon, the numbers were the following. Foreign direct investment was, for every dollar of foreign direct investment in Greece, 90% was in the financial sector, 9% was in the real economy, and 1% in the real estate market. How did that happen? In 15 years. And I explained actually why that happened, because each and every part of the country which was related to its production capabilities, which switched into providing cheap financial related services. It was mentioned before quite correctly that when we did enter the Eurozone, a lot of the numbers were falsified. But was this a mistake? Didn't the European Union know? Of course it did. Of course it did. And of course they facilitated their transactions through using investment banks like Goldman Sachs to assist us and use a daedalus system of financial swaps. Anyway, a lot of interesting financial stories behind it. But the main point is that the reason why they allowed Greece to enter the Eurozone is because its debt was an exceptional example of something which was which was a great opportunity for financial exploitation through all the derivatives which were created out of it, and the billions of euros which were made on speculation on the Greek debt. So we ended up in a position where in 2002, when we joined the euro, the country's debt was 146 billion euros. In 2009, that's, well, the 1st of January 2010, 8 years later, the debt was 298 billion. This is 152 billion euros in 8 years, more than double. More than double. So the debt which was accumulated from 1824, which was the first independence loan that we got from the British and the City of London, up until 2002 was 146 billion. And this is, how much is it? 170 years of history? And within 8 years within 8 years, we accumulated twice that debt. So you can really get it yourself how financially everything works out. And now, just 1 minute, 5 years later, actually in 2011, when the first memorandum was signed, the country's debt was 127% of the GDP, which was again around 153 billion euros. In 4 years of austerity and in 4 years of financial measures, the country's debt is 350 billion and 178% of GDP. Why? Because as I said before, you either finance the difference between the exchange rate through debt, or you finance it through internal devaluation. Or, what's the other term of internal devaluation? Austerity. You cannot tell to people that I'm going to internally devaluate your economy. You're going to use a very sophisticated term, austerity, which is good for you. So I think that the picture is very clear in terms of financially how the system works. And if you take 30 seconds. If you take into consideration, sorry about that. If you take into consideration that the euro itself as a currency is a debt-based currency, the fact that it's privately owned, it means that just for using it equals debt. Because in order for the euro system to get the currency, you have to pay 0.25% interest. And then the banks, because you cannot print money, you have to use the money and borrow it, then the banks, of course, charge it on top of that. There you go. This is how you have a new imperialism within Europe. Yeah. Debt.
Okay, thank you.